sell these out to these large scale funds for lower cap rates than what they bought them for. I want to explain to you guys here is essentially you're going to have investors that are going to buy in from this for multiple millions. You're going to have some that come in with 100,000 and everybody's pooling their money together. And that's how the money is all raised to go out and buy these large facilities. It's not one person that's coming up, multiple millions of dollars. So you're partners with us in this deal as a limited partner. So limited partner means if everything went to hell in a handbasket, everything collapsed, they can't go after the limited partners for anything more than they invested. So that's means you're limited in terms of your liability. So recently there was a storage fund that closed out and it hit about a 24% annualized range of profit. So depending on when you invested into the deal. If you got in on the very, very early stage, then you got the 24%. Maybe if you came in a little later, you got 21%. And they have some that are exiting sometime in the next coming few months that will probably be in the mid 20s in annualized returns as well. So again, if you got 100,000 in and you have a 24% annualized return, that means off the 100,000 that you put in, you're going to make 24,000 per year. So essentially in 4 years, you've doubled your $100,000 investment.
Hey, thanks for being a listener. To find great rental properties and become a more savvy investor, head on over to highreturnrealestate.com.
So what kind of deals do StoreSpace, what do they buy? So they have done some deals where, they pick up an old Kmart building, 100,000 square feet, convert it into 2 storage, put, the self-storage lockers in. And, then other times they get facilities that aren't run very well, that already are performing, but just aren't run well. They tend to prefer buying what he said, a broken bus and fixing the wheels on the broken bus while it's running. That way, all the investors are making money on day one, even if it's not, fully optimized. Let's say they're only getting 50% of their total rent that they could make, but then they know that they can optimize it and keep making more. So on day one, you're making income as opposed on a, abandoned Kmart building when you're waiting for permits and plans to start construction. So my thought is, what's it like right now buying deals, right? That's my question. Like, what's the market like? I know the market is pretty tough and it is really tough to find good deals. All right. So how often do these funds typically open up? So usually, historically, it's opened up twice a year. And before the fund even opens for us as investors, they've already started buying deals into that fund. So they've already started using their own money to start buying deals. And so then they typically put around 6 to 15 facilities into that one fund, raise the capital from us, the investors, close it off, and let that fund do its thing. So we've got a lot of upsides with this, you guys. I mean, it's a very simple model. It's scalable. It's incredible. The typical returns over the last, 120 deals, facilities that they bought. They've been very strong in the mid 20% annualized range. Warren Buffett, one of the most incredible investors on the planet, has averaged 19% annualized returns over his career. So to get these kind of returns is with a collateralized, real tangible asset is amazing. What does collateralized mean? Well, that just means what you're investing in has real tangible asset behind it. It's got real property that's essentially backing up your investment. So one of the things that, about this particular investment that I've been thinking all along that I found out on the interview with StoreSpace is that the downsides that I couldn't leverage this asset, right? So let me give you an example. So let's say I buy a single family home. I put my 20, 25% down, whatever I'm comfortable with, I get the rest in bank debt. That anytime I use bank debt, that's always going to increase my return on investment. Anytime you use leverage, that increases your return on investment. And what I was thinking with this investment in self-storage is that you put your money into the syndication, say, 100 grand, 50 grand, 200 grand, 500 grand, whatever, that you're not able to accelerate that return because as I'm the investor coming into the deal, I'm not able to pull out that debt. However, all of these deals are utilizing bank debt. They're utilizing leverage. It's just we're not the ones that are pulling out that debt ourselves. So as an example, let's say we as investors come in with, 40% equity. So let's say, for example, we're buying into $1 million building. So the investors, we contribute 400,000 and the bank loans 600,000 to buy the $1 million building. So that gives us a fairly big cushion if this $1 million building went down in value to say 700,000, where, we still have equity in the building. But historically, over the last decade, they've driven it from $1 million to 1.4 million in value to 1.7 million in value. So now what that means, this is the beauty of leverage, you guys, you got to get this concept. That means our 400 grand now just doubled or tripled because now it went from, went to 1.7 million, for example, and we have 400K in. So that means the 400,000 is worth 1.1 million because we still have the same $600,000 banknote. So we've driven $400,000 to 1.1 million by taking the building from a value of 1 million to 1.7 million. That's incredible. So that's what makes this so exciting is that, you're getting into a solid asset that people will absolutely rent from. They'll rent these lockers in any economy, good, bad, terrible. It's pretty recession resistant. You've got the ability to not have tenants, toilets, and trash. You have an incredible management team that's backing up and running the whole show, so you don't have to worry about anything. So it's extremely passive. You're able to leverage the asset through the bank debt that the store space, conglomerate pulls into all the deals. And then on top of that, you've got an exit strategy where you create cash flow that comes in while you're waiting for the fund to sell to a much bigger fund. So, these funds will eventually sell out to like a big, large pension fund, a big institutional type buyer where they have multiple hundreds of millions to buy these out. So to wrap this up, if you're interested in this type of deal, reach out to me. If you're accredited, then you can do this. If you're not, you can put this on your goals list and focus on increasing your earnings so that you can get on incredible deals like this that don't have the wild fluctuations of the stock market or crypto, but still have really high and consistent returns. So always here to bring you guys incredible opportunities to grow your net worth. This is why self-storage is my favorite investment. Here we go. Have a great day.
Hey, thanks for your support. If this episode was valuable to you, then show us some love. Subscribe and take 1 minute of your time to leave us a review. This is how we get the word out to help more investors. And best of all, it's good for your karma.